Welcome to TalkTickers. We cut through the noise of earnings calls to give you what really matters for your investment decisions.
That's the plan.
Today we're diving deep into the latest call from Brookfield Business Partners. And right off the bat, it looks like they've been pretty busy. Seems like a strong start to the year.
Yeah, definitely looks that way. The big headline, I think, is the over $1.5 billion generated from what they're calling capital recycling.
Okay, capital recycling. So selling assets, basically.
Essentially, yeah. Selling some things off to free up cash. And they put a good chunk of that right back to work, committed about $370 million to acquire 2 industrial businesses.
Right, so actively reshaping things.
Exactly. It tells you they're not just sitting still. They're looking at their portfolio, figuring out what makes sense to keep and where to reinvest.
So selling maybe mature assets and buying into areas with more growth potential. Industrials, in this case.
Precisely. Suggests they see, good value or opportunity in that industrial sector right now.
Makes sense. They also mentioned reducing corporate borrowings quite a bit. Investors always like to see that, lower debt.
Absolutely. And another big piece, the share buybacks. Nearly 6 million units and shares repurchased.
Wow, okay. Part of that $250 million program they announced.
That's the one. And they've already returned $140 million to shareholders through it. So they're moving pretty quickly on that front.
Yeah, that's a strong signal, isn't it? Management basically saying they think the shares are cheap.
It usually is, yeah. That, and it directly boosts things like earnings per share by reducing the share count. The fact they've already done a fair bit of it suggests, well, real conviction.
Okay, let's look at the actual performance numbers. Adjusted EBITDA saw a nice jump, right? $591 million.
Yep, up from $544 million in the prior period. So a healthy increase there.
What's driving that? Just general strength?
It points to, underlying strength in operations. We'll need to dig into the segments to see exactly where it's coming from, but the overall trend is positive.
And the adjusted EFO, that's funds from operations, came in at $345 million.
Correct. Though, you got to unpack that number a bit. It includes a pretty big net gain, $114 million, from selling their offshore oil services shuttle tanker business.
Ah, more capital recycling there.
Exactly. But it also includes a $34 million hit from withholding tax expense. So, a couple of moving parts in that EFO figure.
Right. The sale boosts it, the tax drags it down a bit.
Got it.
Okay, let's dig into those segments then. How did the industrial segment do?
Industrials looked pretty solid. Adjusted EBITDA was $304 million. But again, context is key here.
What's the context?
Well, that number includes a substantial $72 million tax benefit at Clareos, their advanced energy storage operation.
$72 million. Okay, that's significant.
It is. And it also includes contributions from a company they acquired recently, an electric heat tracing manufacturer. So a mix of things boosting that segment.
So organic help from the tax benefit and inorganic growth from the acquisition. Multiple levers.
Precisely. And looking deeper within industrials, Clareos seems to be doing well. Growing demand for higher margin advanced batteries, plus operational improvements.
That makes sense with the whole EV and energy storage trend.
Right. But on the other hand, their engineered components business, Dexco, saw lower volumes, some end market weakness there.
So a bit of a mixed bag within the segment itself.
Yeah, exactly. Dexco is managing costs actively to try and offset that lower volume, but it shows the diversification, one part growing strong, another navigating headwinds.
Okay, let's switch to business services. Adjusted EBITDA there was $213 million, up from $205 million.
And that prior year number actually included a road fuels operation they've since sold off.
Ah, so the underlying growth is actually a bit stronger than it first looks. What drove that?
Key drivers were strong performance in their residential mortgage insurance business and also better execution on some construction projects.
Good signs there.
Yeah.
But not everything was rosy.
No, their dealer software and technology service operation faced some challenges, higher costs, mostly due to tech modernization efforts.
Investing for the future, but it costs money now.
Right. And they also mentioned some customer churn there, which they'll need to manage. You invest in tech, you want the customers to stick around to see the benefit.
Makes sense.
Yeah.
Okay, third segment, infrastructure services. Adjusted EBITDA was $104 million, which is down from $143 million last year.
Yeah, but remember that prior year number included those offshore shuttle tankers they sold. That accounts for a big piece of the drop.
Right, the divestiture impact again. So how did the remaining businesses do?
Performance was a bit varied. Modular building leasing and their lottery services were pretty stable. Steady eddies, you could say.
Okay.
But market conditions were weaker for their work access services business, so that offset the stability elsewhere. Different dynamics at play.
Gotcha. Let's talk capital allocation. How are they positioned financially?
They ended the quarter in a pretty strong position, about $2.3 billion in liquidity available.
That's a good cushion.
Eh.
And the share buyback, still going.
Yep, ongoing. And they indicated it'll likely be renewed. Their priorities seem clear. Keep deleveraging, keep returning capital to shareholders.
Through those buybacks, maybe dividends too.
Right. And also make strategic investments where they see opportunities. Seems like a balanced approach.
And speaking of strategic moves, they announced a couple of interesting ones. An agreement to acquire Antilia Scientific.
Yeah, a company that makes consumables and testing equipment for labs. Critical stuff.
And they explicitly mentioned opportunities to improve its operations. Classic private equity move, right? Find efficiencies, add value.
Exactly. Plus, it gets them deeper into that, potentially more stable life sciences and lab sector. Good diversification.
They're also investing quite a bit in digital for their lottery business. New head of digital hired, expanding the team.
Yeah, that's a clear sign they're aiming to capture more of the online and mobile lottery market globally, not just sticking with the old ways.
Adapting to how people play now.
Definitely. Recognizing that shift is crucial.
And then there's the move into financial infrastructure, participating in the investment into Barclays Payments business. That's interesting.
It is. It broadens their definition of infrastructure, doesn't it? Seeing payment processing as a critical, potentially stable sector.
Yeah, plumbing of the financial system, essentially.
Sort of, yeah. And one more on the strategic front. Merging Scholar Albert with IPL Plastics.
Creating a big, sustainable packaging player.
Right. And importantly, for BBU investors, they noted this merger doesn't require any additional funding from Brookfield Business Partners itself.
Ah, so creating value through consolidation without putting more capital in. That's efficient.
It's a good sign, yeah. Shows active management of the existing portfolio.
Okay, what about the macro picture? Tariffs, economic headwinds. Are they worried?
They're monitoring it, of course.
Yeah.
But they don't anticipate a material impact on overall cash flows.
Why not?
Largely because many of their businesses operate regionally. That diversification across geographies provides a buffer against, widespread global trade issues.
That makes sense. A global footprint, but regional operations.
Right. Now, they did acknowledge some exposure at Dexco, the components maker, related to imports from China.
Okay.
But they say they're actively working on mitigation strategies, things like nearshoring, finding alternative suppliers, cost optimization.
Being proactive.
Exactly. And for Clareos, the battery business, they expect a USMCA exemption should limit any tariff impact there. So they seem to be managing the risks pretty actively.
Good to hear. What about taxes? You mentioned that benefit for Clareos earlier. Anything else on that front?
Just that regarding Clareos, again, they filed their 2024 tax return, which includes claims for certain tax credits. It's going through the normal review process.
And they feel good about getting those credits.
They expressed confidence in their eligibility, yes. If they get them, it's another, potential boost to the bottom line there.
Okay. And one last specific point, the mortgage insurance business. Did anything change there?
Yeah, actually. They mentioned that recent regulatory changes, like an increase in the mortgage insurance cap and extending the amortization period for first-time buyers, have directly led to higher transaction volumes for them.
Ah, so policy changes are actually providing a tailwind for that business.
Exactly. Expanding the pool of potential customers for their insurance products.
Okay, so let's try and wrap this all up. Putting it together, what's the main story for you, for investors listening to this call?
I think the big picture is a company actively managing its assets, selling some, buying others, like Antilia. They're clearly focused on returning capital through those significant buybacks. And they seem to be navigating this complex environment, tariffs and all that, pretty proactively. The adjusted EBITDA growth is solid, and strategic moves in digital lottery and financial infrastructure point towards future growth areas.
Right. Seems like they're juggling quite a few balls, but keeping them mostly in the air.
That's a fair way to put it, yeah.
Okay, now for our favorite part, the This Is Not Financial Advice segment. Time to brainstorm some, let's call them creative trade ideas based on what we just discussed.
Always interesting. What have you got?
Okay, here's one. Building on that Antilia Scientific acquisition, they're buying this lab consumables company, looking to improve it. So how about this? Go long a basket of smaller, publicly traded companies in that same space, niche lab equipment, consumables.
Okay. The idea being they might be future acquisition targets.
Exactly. Potential M&A targets for bigger players looking to consolidate, maybe even like Brookfield down the line. Now, here's the hedge, the slightly wilder part. Pair that long position with a short position on a broad index fund that's heavily weighted towards, say, traditional manufacturing. Companies may be more exposed to economic slowdowns or supply chain snags.
So betting on relative outperformance from the life sciences lab sector, potentially juiced by M&A hopes versus more vulnerable old school manufacturing.
You got it. The thesis is that lab space could be more resilient, maybe even see some excitement, while traditional industry faces more headwinds. But seriously, remember everyone, this is just us kicking ideas around, purely a thought experiment.
Definitely not financial advice. Do your own homework.
Absolutely. Thorough research is key before you even think about making a trade. That's just food for thought.
A bold one, but it ties into the themes from the call.
Okay, that wraps up our deep dive into the Brookfield Business Partners earnings call. We've hit the key financials, the strategic moves, management's outlook.
Hopefully giving you a clearer picture of what's happening with the company.
Yeah, we encourage you to dig deeper yourself, see how these insights might fit into your own strategy. Let us know what stood out to you from this analysis.